So, Kevin, I have to ask you, there was just this article in the Wall Street Journal. Allegedly, the headline is something like the worry lurking under the market gains. And what they pointed out was that investors are shifting to utilities, healthcare stocks, and of course, I forget what the third was. It was utilities, healthcare stocks, basically protecting themselves from consumer staples, because people still need those things.
Yes.
If there's a recession. Did you see the article, and what did you think?
I did see the article, and it doesn't necessarily surprise me, although many other retail investors that I've been speaking with over recent weeks across the country have become somewhat complacent. We've been on a record run in the stock market thus far, absent much significant sustained volatility, and investors shouldn't anticipate that lasting forever. As it stands right now, all 11 GIC sectors are positive year to date. That's not typical. Of course, the top 4 performing sectors are all related to the AI revolution trade. One of those sectors you mentioned earlier, that being utilities. Utilities used to be that boring sector. All of our fathers would invest in utility stocks. They hold up well in the face of volatility. They pay good dividends. But now they've become a backdoor play into the AI revolution because they supply the power that all of these data centers need to run these intensive algorithms. So where do we stand for the balance of this year? I wouldn't be surprised to see some more short-term bouts of volatility. However, I believe that each one of those bouts of volatility will be greeted by more money coming off the sidelines. A lot of that money that was invested in short-term CDs or treasury bills over recent years is now, unfortunately, going to try and play catch up in the stock market and probably go into those areas that have run up so much over the past couple of years and are now trading at excessive valuations.
And I realize these are time-specific questions for video content that people will be seeing a day, 2 days after we have this discussion. But let's talk about treasury yields. You understand better than perhaps people like me. The yields are telling me that people are not taking risk, that and they're not running for the exits, but they're preserving. They're going to the side. That would worry me because I like the risk of equities. I only recently moved to the side. And there would be strategists who say that I waited too long. But I still think there's risk worth taking, even though I hear a lot of doom and gloom on CNBC and on Yahoo Finance. Like the 1929 book that just came out, comparing the current debt loads and what happened in 29 to where we stand today. What am I missing? Should I be risky or should I be preserving?
I believe that investors should stay true to their risk tolerance regardless of the market environment and regardless of economic conditions. In other words, Adam, let's say the market is screaming higher, as it has been over the last 2.5 years now. That doesn't necessarily mean that you should get more aggressive, just as much as it shouldn't mean that you should get less aggressive when the market is moving downward. In other words, stay true to your risk tolerance, stay consistent with what your investment time frame is, and ultimately what your goals and objectives are. The biggest risk that most investors make, and the biggest mistake that often results from that risk, is that they try and time the market. Look, I've been doing this for over 3 decades now. I can't time the market because you got to get it right twice. When to get out and when to get back in. It's when to get back in that's often most difficult. And there was a study that was done recently that looked at 20 years worth of stock market returns ending in 2024. What it found was that 7 of the 10 best days in the markets over those 20 years came within 2 weeks of the 10 worst days. Adam, I wish I knew when those 10 worst days were, but I don't have a crystal ball, at least not in the office with me here today. But what I do know is if you're not in the market on those 7 days, you're likely to miss out on the most significant returns that the market has to offer. So build diversification into your portfolio consistent with what your true risk tolerance is. If the stock market pulling back by 5 or 10% in a given month causes you to lose sleep at night, not you, but the proverbial you, well, then maybe you should have a less risky portfolio and mix in other asset classes to help dampen that volatility, such as bonds or other alternative investments. It's not one cookie cutter approach for all investors.
My risk tolerance, unfortunately, is the middle-aged guy driving the convertible with a six-pack and no seatbelt. So that should give you, I mean, I would go off the cliff.
Please wear your seatbelt.
I know I wear a seatbelt when I drive, but I love V8 engines. Well, what about, and I was talking about the Andrew Ross Sorkin book, and look, people love fear. It really is a driver of so many things. And yet, on a day when you would have thought markets would be selling off, as I'm talking to you right now, I believe the S&P 500 is up 1%.
Yeah.
And it's basically on the possibility of, and it's the China trade talks. When President Trump meets with Xi, will they work out some way around this tariff war? So what that tells me is, shouldn't the market be driven on earnings? And we are in the middle of earnings season, and not on speculation about these negotiations.
Yes, a lot to unpack there. Let's start with the economy. As it stands right now, according to the Federal Reserve, based upon their updated summary of economic projections that they released in September, they believe the economy is going to slow to a growth rate of 1.6% by the end of this year, real GDP growth, which is inflation adjusted. Right now, the most recent Atlanta GDP now forecast for the third quarters is in the high 3%. So what gives? What's the reason for such a difference? What does the Federal Reserve know that's not coming through in the economic data numbers, at least up to this point in time prior to the shutdown? But the Federal Reserve is not forecasting a recession. And if I look into the earnings strength in the third quarter right now, year over year earnings growth is forecast to be roughly 8.5%. If that holds, that'll mark the 9th consecutive quarter of year over year earnings growth. So if earnings continue to grow, and if the economy continues to grow, albeit at a slower pace, that means we don't have those dire recession type of concerns. And then you sprinkle in the high likelihood now that the Federal Reserve cut interest rates by another 25 basis points next week at the end of October, and yet another 25 basis points in December. Well, that should help alleviate those recession concerns even more. Perhaps to fuel the inflation concerns, but alleviate some of those recession concerns.
I will get this incorrect as I quote it, but you'll understand the gist of where I'm going. I think it's Warren Buffett had that ratio of when valuation to GDP.
Yes.
When we are very high in market valuation compared to GDP, time to take some profits off the table. Is he accurate in that metric? And I realize, again, kind of like trying to time a market, but is it an accurate strategy, and where would we stand in that right now? I believe we'd be at the highs of valuation.
Yeah, I think you have to look at what areas of the market that are really fueling some of those excessive valuations. And you'd have to lean into the technology sector as a result, such as the Mag 7. But to kind of get worried about the Mag 7 or get concerned about the technology sector or the AI revolution as a whole, you have to look at where we stand within the AI revolution. And I still contend, Adam, to use a baseball analogy, that we're just in batting practice of a doubleheader. Batting practice of the AI revolution involves all the AI infrastructure buildouts. And according to Jensen Huang, the CEO of NVDA, he believes that there will be somewhere between $3 to $4 trillion with a T spent on AI infrastructure investment by the end of this decade. As I understand it, right now we're about 600 billion. So to get to 3 to 4 trillion by the end of this decade tells me there's going to be more investment and more investment opportunities associated with that. Now, once we move out of batting practice into those two games, when all of a sudden all these hardware and software companies have spent billions of dollars on all the infrastructure and capabilities, start to utilize their AI, and we'll see if in fact that transform their bottom line and if they get a return on their investment. And I believe that there'll likely be more losers than there will be winners, and there's going to be many bumps along the road in this AI revolution. But as it stands right now, I think there's more room to grow for those companies that benefit from all of this infrastructure spending. And while valuation, of course, is important, perhaps it's not as important as it would be in some of those other sectors or some of those other areas of the market for those reasons.
Help me understand what I'm getting wrong. I read an article that talked about the dangers of AI companies, and we're talking about the big ones, investing in each other.
Yes.
And what I took from it was actually not that that's dangerous, that would protect me as an investor from the kind of opaque transactions that took place that drove up valuations inappropriate.
Yes.
So what did I get wrong in my understanding of that article?
I don't know if you necessarily got anything wrong. My take on this whole wave of AI circular financing deals, it just shows me the interconnected nature of the AI ecosystem as it stands today and how reliant the large cap players are upon each other. In fact, I often think of it as the game Survivor, as all these large cap tech players are racing to make strategic deals with one another to help promote their ultimate survival in the AI race. And I think that could be to the detriment of some of the smaller cap players and to the benefit of these larger cap players. However, there are consequences. There are short-term and there are long-term consequences associated with all of these circular financing deals, whether it relates to economic considerations or control considerations. It may make sense today, and they may need to do it now to keep pace with the revolution and not fall behind, but down the road, they may be paying for these deals that they made today. So I'm taking each one of these with a grain of salt. And I'm also reminding all of our clients that there are other opportunities associated with the AI revolution beyond NVIDIA and beyond the large cap players. And if I could just name a couple of those for you now, Adam, maybe it would help make that point. So there's a company out there called IES Holdings. Who the heck are they, right? They're the industrial sector, but they supply the power and connectivity for data centers. There's another company that's associated with data centers as well in the industrial sector. They're called Comfort System, ticker symbol is FIX. They supply the cooling solutions to data centers because we know how hot they run. You might be surprised to know that both of those stocks, as of the end of last week, were up over 100% year to date. Hey, NVIDIA's having a great year. I think they're up 39% themselves, but 100% year to date because they're associated with the AI revolution. So peel back the onion and you might find some additional opportunities in the AI ecosystem that aren't just necessarily loaded up in that technology sector, which is a little frothy right now.
Yeah, this is an obvious question, perhaps. Again, correct me when I get it wrong. It would seem to me that's a way to protect yourself, especially when critics say, the top Mag 7 drive, 40% of the S&P 500. Well, if you believe that,
yes,
one way to benefit from the AI revolution is just what you said. Go for those which aren't driving the S&P 500.
Without a doubt. And I think there is a more diversified way to play AI investing as it stands right now. If you look at all of the potential benefactors of the AI ecosystem. And here's another great example and a way to highlight this. And you might recognize these names, so it's not going to be unfamiliar small cap names. But a company like Taiwan Semiconductor, the largest dedicated chip foundry in the world, about a 60% market share. You know who their biggest client is? NVIDIA. NVIDIA doesn't make their own chips. Taiwan Semiconductor does. But even Taiwan Semiconductor doesn't do their own lithography for their chips. ASML does. ASML's biggest client is Taiwan Semiconductor. Taiwan Semiconductor's biggest client is NVIDIA. So every time you hear this blockbuster earnings report from NVIDIA, NVIDIA's taken over the world. They're the hub of the AI ecosystem. Maybe all that's true, but there are other companies that stand to benefit from that as well. And I think investors would be wise to not just try and pick the one or two hit wonders, but build a portfolio of 25 to 30 different names that stand to benefit and each operate within different nodes of that AI ecosystem, some of which may be trading at much more attractive valuations than the names that you always see in the news headlines each day.
Can you share with us, how is it that you find those companies that, I'm focused, as are so many people, on the CNBC and the Bloomberg and the Yahoo Finance headlines. You've just given real valuable information about, here's two stocks to look at. How do you find them? And can you share any more with us? Because I know people watching are looking for that which CNBC and Bloomberg are not paying attention to.
Sure. So I have a great research team here at Hennion and Walsh and on the Smart Trust team that looks for these opportunities, looks for those companies who have stated commitments to performing activities that are related to the AI ecosystem. And I think about one example that we use going back a couple of years now with a company called Vertiv Holdings. Ticker symbol is VRT. At that point in time, they were an unknown HVAC provider. Well, relatively unknown. I shouldn't mock them. They were a large player and a very successful company, but they were an HVAC provider to warehouses and distribution centers. Now, what's happened over the last 2 years is that many of these warehouses and distribution centers have been converted into data centers. So now they picked up all the contracts to supply the cooling needed for data centers, and their stock ran. So when I saw that type of performance, I turned to my research team and I said, this company, Vertiv, can't have a monopoly on cooling for warehouses. There has to be others. And then we stumbled across looking at company reports and publicly available information and press releases and websites that there was another company called Modine Manufacturing who did something similar. Wow, that's interesting. Are there others out there? Yes. Comfort Systems, ticker symbol FIX, which I mentioned earlier. Stock is up almost 100% year to date. So to continue to peel back the onion, you find them. And here's a wonderful example, I think. And I know we keep patting ourselves on the back here, at least me and my team here, but I am very proud of them. There's a company out there that was one of the top 10 performing stocks in the S&P 500 last year. When I tell you the name, you're going to say, that can't be the company I'm thinking about. What the heck do they have in the AI revolution? And how did their stock do so well? But this company is Iron Mountain. The same Iron Mountain, yes, where you used to store your tax documents for 7 years in case you get audited, all of your excess files from your corporations. But what happened is, as a society, we don't store as much paper anymore. So Iron Mountain, which is a REIT, pivoted and leased out their excess warehouse space to data centers. And they became part of the AI revolution. And they provide a good dividend income as well. So the more you dig into the actual revolution, you see other companies that are benefiting or may benefit further, and you want to build a collection of those companies within a more diversified portfolio, in my opinion.
When you brought them up, I was thinking about this TV show. I think it's on Amazon Prime called Upload, and it takes place in the future. It's about technology, and one of the big companies is Oscar Mayer Intel. It gives you, the mergers that'll take place. Let's wrap up. I am sure. So we do have the Fed meeting. We know there's going to be a rate cut, unless God forbid something drastic happens in the next couple of days. And then in December, potentially another rate cut. What do you want people to pay attention to that right now is not on their radar screen?
I think there's a number of things. So you're correct. As it stands right now, I looked at Bloomberg earlier this morning, and it looks like the bond market is forecasting a 99% chance of a rate cut next week in October, and then a 104% chance of a rate cut in their December meeting. I don't know how you get above 100%, but I guess it's all but assured that there'll be 2 more rate cuts this year of 25 basis points each. That's baked into the pudding right now and baked into the markets, if you will. Obviously, if the Fed doesn't do that, that would take the market off guard. I'm also paying very close attention to all the outtakes of the trade negotiations between the U.S. and China. They need our chips. We need their rare earth minerals. But we're also in the United States now looking to not be as reliant upon China for rare earth minerals down the road. But that's going to take years, and we need that now. So I think China remains at the top of this global tariff and trade fight card, the main event, if you will. And investors maybe aren't discounting that into the markets enough. The last thing is around the government shutdown. Historically, that's actually been a net benefit for the markets, not a detractor. I believe we're on day 20 right now of the shutdown, the third largest shutdown in our country's history. If, in fact, it remains shut down for another week, then the Fed is flying blind into their next meeting. But I think that assures that rate cut. So I'm just looking at the outtakes of U.S. and China right now. I hope that the Fed does what they told us they were going to do with those 2 additional rate cuts. If they don't, now maybe those recession types of conversations start to percolate again now.